So this year alone, I've already made a total of 1,373 transactions. Last year, I made a total of 12,194 transactions. So you can see why I don't keep track of anything, right? Because there's no way I'm going to write down all 12,000 transactions and keep track of everything. So throughout the entire year, I don't keep track of any of my crypto transactions. Whether I buy, sell, spend, none of that. Most people will actually tell you to write down what you bought, at what price, and when you bought it, and when you sell it. Instead, I use a tax software system like Koinly, which saves me a ton of time. First, I go to all the exchanges that I use, I download all my transactions, I plug it into Koinly, it prints out a Schedule D where it calculates all my profits and losses from what I bought, when I bought it, at what price. Then with that Schedule D, I give it to my CPA, he crunches on all the numbers, and I'm done. So in this video, I'm going to be sharing that entire process and some of the basic things you need to know about taxes. So if that sounds interesting, definitely stick around. First of all, thank you Koinly for sponsoring this video. If you guys are interested in signing up, I do have a referral link down below. Here are all the exchanges and platforms that I use, and Koinly, surprisingly, was actually the only place that accepted all my transactions, read all my API keys, and I had no problem with. I've tried 5 to 6 different other tax services. One wouldn't work, the other wouldn't be accurate, some couldn't receive some transactions and couldn't read some files, but Koinly was, from my personal experience, the best one so far. But before I continue, I do want to remind everybody that I am not a financial advisor, nor anything that I share in this entire video financial advice. I am not a CPA nor a professional. Everything that I share in this video is from my personal experience and things that I've learned from my CPA. So make sure you do your own research and due diligence and consult with a professional before you decide to move forward with everything or anything that I share in this entire video, because we're dealing with taxes. This is a pretty serious and a pretty big deal. Number one, do I need to pay taxes on crypto? Depends on where you live, but the short answer is yes. If you live in the US, you definitely do not want to mess with the IRS. Once they audit you, you have someone always breathing, down back at your back. You just don't want to deal with that, so make sure you pay taxes if you owe taxes. Crypto at the time of making this video is still considered like property. So if you buy and sell under a year, it'll be taxed as short-term capital gains. If you buy and sell after a year or over 1 year, that will be taxed as long-term capital gains. Long-term capital gains tax is definitely more favorable, so you'll pay less taxes versus short-term, you'll have to pay a little bit more, but that's really going to depend on your income level. If you're spending your crypto, that is considered a taxable event, because what you're doing is you're converting your crypto into fiat and then you're spending it. If you spent your crypto while you were at a loss, well, you're going to have to report those losses, which is actually going to play in your favor later on. If you spent your crypto while you were up or you were positive and you sold, well, then you're going to have to pay taxes on those gains. If you earn interest through staking your stable coins, that is going to be considered as income, so you're going to have to pay taxes on the interest or the gains that you have made. If you earn interest through a cryptocurrency like Bitcoin, where the price fluctuates, that's going to be a little bit more complicated, right? But to keep it simple, let's say yesterday you got paid out $20 in Bitcoin. Well, you're going to have to pay taxes on that $20 initially because it's considered as income. Now, let's say a year from now, the market goes up 50%. Well, that $20 is now going to be worth $30. You're not going to have to pay taxes on that $10 gain until you sell it. Again, if you sell it under a year, short-term capital gains tax. If you sell it after a year, it's going to be considered as long-term capital gains tax. Now, if you have a crypto bot running, this is definitely a little bit trickier because there's just not a lot of information on this, but to be very safe, consider short-term capital gains tax. Unless you have something like the ETH Moonbot running, like I do, I would report the profits as short-term capital gains tax and the unrealized gains as long-term capital gains tax or short-term capital gains tax, depending on when I decide to close out the bot. If you convert or swap or exchange one cryptocurrency to another one, that is considered a taxable event, because ultimately what you're doing is you're selling that cryptocurrency to buy another one. For example, if you have $100 worth of Bitcoin and it doubled to $200 and you decided to convert it into a stable coin like Tether or USDC, then you're going to have to pay gains on that $100. Or if you convert it to Ethereum, then yes, you're going to have to pay taxes because it is still considered a taxable event. Last but not least, if you bought into some cryptocurrency because some person recommended it and you sold it at a loss, I highly encourage you to still report those losses because it could actually play in your favor and help you lower your tax bill. It could also help you offset some of the profits that you might have made throughout the year. So for example, say you invested $1,000 into cryptocurrency 1 and $1,000 into cryptocurrency 2. One went up 500%, one went down 500%. If you sold it under a year, well, you can offset it and you made $0. So depending on your situation, your timeline, your strategy, and how you position yourself, selling at a loss could be beneficial for you. Of course, personally for myself, I don't recommend people selling at a loss, but that's going to be completely up to you. So those are some of the basic things that you should know about cryptocurrency and taxes. I know it can be extremely annoying. Everything seems like a taxable event, which is why I recommend iTrust Capital. iTrust Capital is a crypto IRA where you can retire with cryptocurrency. You can make unlimited trades with inside it, and all the gains you make will be completely tax-free. If you're interested in learning more, check out the video that I made on them, link down below, and you can earn a $100 bonus just by signing up. They have a ton of cryptocurrencies listed if you wanted to trade them or invest long term, and you can even invest into gold and silver if that is something that you are into. You have until April 18th to max out your contribution for the year of 2022. If you do it after April 18th, then you will be contributing to 2023. This is my wife's IRA, and I'm actually going to buy some Bitcoin in her account because I feel like 40.4K is a excellent level to be accumulating. So right now I have $2,900. I'm going to contribute the max amount. There is a 1% trading fee, which I do not mind at all because if Bitcoin gives me a 100% plus return, who cares about the 1%, right? That's just my opinion. Submit market buy. And my purchase has been complete, so I can trade as much as I want in this account and all the gains will be completely tax-free. So right now we are in Coinly's website. Now, one thing that's really nice about Coinly is that you can actually import all your trades first, and then you can preview all your capital gains, all the gains you've made, the amount you have, and if you feel like, wow, everything looks good, I like this, that is when you can move forward, pay for their services, and then you can download their tax documents. Now, Coinly's dashboard is actually really nice compared to a lot of other crypto tax software systems that I've personally tried out. You can keep track of your total value, your cost basis, your unrealized gains, all of your holdings after you've imported your documents. My numbers are actually way off just because I did this 2 months ago. Ever since then, I haven't updated my files and I've moved my funds around, so everything's just very confused right now. But overall, you'll get the general idea and the general point. So this year alone, I've already made a total of 1,373 transactions. Last year, I made a total of 12,194 transactions. So you can see why I don't keep track of anything, right? Because there's no way I'm going to write down all 12,000 transactions and keep track of everything. Instead, I would rather trade freely, invest freely, plug everything in, and have Coinly do everything for me. It'll tell me how much I received, how much I sent, my income, my expenses, my trading fees, and my realized gains. But the first thing you would do after you create an account, you would actually go click on wallets, and then you would click on add wallet/exchange. And they have so many different exchanges and wallets available. They even have Cash App on here. That's just mind-blowing to me. Now, in most cases, they should have major exchanges and wallets that a lot of people use. MetaMask is a very popular one. They have that available, or maybe you use a Solana wallet, but you can scroll through all the different pages and see all the different types of wallets that they have. They have an incredible amount, which is why I personally loved using them this year. Now, the way you connect the exchange that you use to Coinly is all going to be different depending on what you use. So Crypto.com, for example, if you click on import from file, it's going to ask you to import the CSV file. If you're not sure how to do that, you can click on instructions, and Coinly will actually tell you how to do everything, which is pretty amazing. If you are an FTX user, well, it's going to be very similar as well. You have the instructions and it'll let you know how to do everything step by step. If you use an exchange like Coinbase Pro, well, you can actually sync up everything automatically by entering your API key, API secret, API pass. If you're not sure how to do this, then you just have to click on learn how to find this information. And again, Coinly will tell you everything. Once you've connected your exchange and all the apps that you use, you can click over to tax report. You can see all the capital gains tax, your income, costs and expenses, and then you can click on your report type, whether you need a Schedule D, whether it's for TurboTax, whether it's for income report, whatever it may be, whatever you need it for, you can download it. In this example, I would need my IRS report. I already paid for my services, so I can download it right away. And then you should receive an email with a link so that you can download your documents. You're not going to be able to see my numbers, but it's going to look something like this. Now, what's really cool about Koinly is that they have a cost basis method, and you can actually change this method if you wanted to. Not only that, they have a ton of different options and settings that you can choose from. So over on settings, you can click here and you can check, do you want to treat mining as income, treat forks as income, treat airdrops as income. So these are things that you can decide. I just keep everything at default the way it is, but on the cost basis method, you have 4 different options: average cost basis, first in first out, last in first out, and highest cost basis. Koinly actually has an entire blog explaining what is a cost basis in crypto. If you wanted to read more in detail, definitely check it out. But if you scroll down, we'll go over FIFO because that's the one I chose. First in, first out is one of the most common cost basis methods, and it's very straightforward. FIFO means the first asset you buy is the first asset you sell. Let's say you bought one Bitcoin at 20K, and then you bought another Bitcoin at 40K. And then when Bitcoin hits 60K, you decided to sell one Bitcoin. Instead of selling the one that you bought at 40K, you would be selling the one that you bought at 20K. You may or may not like that, but it really depends on your timeline and when you bought everything. If you want to go the other direction, you can go the last in and first out. This cost basis method assumes that the first crypto sold is the last crypto bought. May result in lower taxable profits, but only permitted in a few countries, so USA and Australia. If you bought one Bitcoin at 20K and another one at 40K, and you decided to sell one Bitcoin when it hits 60K, then you would be selling the one that you bought at 40K because that's the last in and that's the first out. So there really isn't like one is better than the other or one will save you more taxes than the other. It just really depends on like what you bought, when you bought it, how you want to be taxed. You want to be taxed short-term or long-term. But what you can actually do is select one of these, click save, go back to the tax report, and then you would have to wait a little bit because it's going to update all your gains, and then you can check out which one is better for you. In my case, I found that first in, first out was better for me, so that's the route that I personally chose. Well, with that said, hope you all enjoyed this video. If you did, please give it a big thumbs up. If you have any questions or comments, leave it down below. Make sure to file your taxes by April 18th and contribute to your IRA if you have not. Definitely check out iTrustCapital, and thank you Koinly for sponsoring this video. I'll see you guys in the next video. Over. Good night, good morning. Adios.